Crypto markets move fast, and emotions can rise even faster. Panic selling happens when investors sell assets out of fear instead of strategy. The first step to avoid panic selling is understanding market volatility. Prices in crypto can rise or fall sharply within minutes or hours. These movements are normal and do not always reflect long-term value. Educating yourself about blockchain and market cycles builds confidence. When you understand the system, sudden drops feel less threatening. Having a clear investment plan reduces emotional decisions. A plan should include entry points, exit points, and long-term goals. Without a plan, every price movement feels like an emergency. Long-term thinking helps reduce fear during short-term dips. Many successful investors focus on years, not hours or days. Avoid checking prices constantly throughout the day. Frequent checking increases anxiety and emotional reactions. Set specific times to review your portfolio instead. This helps you stay calm and objective. Diversifying your portfolio also reduces panic risk. When you spread investments, one drop feels less damaging. Putting all money into one coin increases emotional pressure. Risk management is essential in crypto investing. Only invest money you can afford to lose. This mindset reduces fear during market crashes. Fear often comes from overexposure to risk. Understanding that corrections are normal helps maintain stability. Even strong cryptocurrencies experience major price drops. These drops are often followed by recoveries over time. Avoid following hype or emotional social media posts. Online panic can spread quickly and influence decisions. Not every market dip is a reason to sell. Learning to differentiate noise from real news is important. Trusted research sources help reduce emotional reactions. Technical knowledge improves decision making under pressure. Emotional discipline is a skill that develops over time. The more experience you gain, the calmer you become. Writing down your investment strategy can keep you focused. A written plan acts like a reminder during stressful moments. Panic selling often leads to locking in losses unnecessarily. Many investors regret selling too early during fear. Staying patient can sometimes lead to better outcomes. Market cycles always include ups and downs. Understanding cycles helps you stay grounded. Emotional control is just as important as technical analysis. Fear and greed are the two strongest market emotions. Recognizing fear helps you stop reacting blindly. Taking breaks from charts can improve mental clarity. Step away when you feel overwhelmed by price movements. Calm thinking leads to better financial decisions. Panic decisions are usually based on short-term thinking. Long-term vision reduces the urge to sell quickly. Confidence in your research builds emotional strength. The goal is to respond, not react to market changes. Discipline separates successful investors from emotional ones. Staying informed without overreacting is key. Crypto investing rewards patience over panic. The foundation of success is emotional control and preparation. One of the most effective ways to avoid panic selling is setting stop loss levels in advance. A stop loss helps you define your maximum acceptable loss before emotions take over. This removes guesswork during sudden market drops. Pre-planned decisions reduce emotional pressure. It is easier to follow rules you set in calm conditions. Emotional decisions usually happen when there is no clear plan. Keeping a journal of your trades can improve discipline. Writing your reasons for buying helps you remember your strategy later. This reduces confusion during volatile moments. Many panic sellers forget why they invested in the first place. Revisiting your original goals can restore confidence. The market dips often feel worse than they actually are. Perspective is important when evaluating price movements. Zooming out to longer time charts helps reduce fear. Short-term drops often disappear on weekly or monthly charts. Avoid making decisions based on one bad day in the market. One-day performance rarely defines long-term success. Emotional reactions are strongest when you feel uncertain. Increasing your knowledge reduces that uncertainty. Confidence grows when you understand market behavior. Social media can amplify panic during downturns. Many posts exaggerate losses and ignore recovery patterns. It is important to filter unreliable information sources. Not every influencer gives accurate financial advice. Blindly following others often leads to poor decisions. Developing independent thinking protects your investments. You should always verify information before reacting. News headlines are often designed to trigger emotional responses. Fear-based headlines do not always reflect reality. Staying calm allows you to see opportunities others miss. Experienced investors often buy when others panic. This requires emotional control and patience. Having a strong reason for investing reduces fear. When your conviction is strong, temporary drops matter less. Weak conviction leads to emotional exits. Always ask yourself why you invested in a coin. If the reason is still valid, panic selling is unnecessary. Keeping a long-term vision is essential in crypto markets. Short-term noise should not override long-term plans. Avoid making impulsive decisions decisions after sudden price crashes. Waiting 24 hours before reacting can improve judgment. Time helps reduce emotional intensity. Calm analysis often leads to better outcomes. Emotional reactions usually fade with time. Having patience is one of the strongest investing tools. Practice staying calm during small market dips. Small experiences help build emotional resilience over time. Volatility feels less intimidating. Learning from past mistakes improves decision making. Every investor makes emotional errors at some point. The key is not repeating them. Reflection helps turn mistakes into lessons. Crypto markets reward those who stay disciplined. Panic selling usually benefits long-term buyers, not sellers. Staying focused helps you avoid becoming your own worst enemy. Building emotional awareness is essential for handling crypto volatility. You need to recognize when fear is influencing your decisions. Fear often feels urgent, even when nothing has fundamentally changed. Pausing before reacting helps break emotional cycles. A short pause can prevent costly mistakes. Deep breathing or stepping away from charts can reduce stress. Clear thinking is difficult when emotions are high. Many investors sell simply because they feel uncomfortable. Discomfort is not always a signal to exit the market. Learning to tolerate volatility is part of investing. Strong investors accept uncertainty as normal. Uncertainty does not mean danger in every case. Reviewing your risk tolerance helps you stay aligned with your plan. If your investment feels too large, fear increases quickly. Adjusting position size can improve emotional stability. Smaller positions reduce panic during downturns. Over-leveraging is one of the biggest causes of panic selling. Borrowed funds amplify both gains and losses. Liquidation risk creates extreme emotional pressure. Avoid using leverage unless you fully understand the risks. Spot investing is generally more stable for beginners. Simpler strategies reduce emotional complexity. Complicated strategies often lead to confusion and fear. Consistency is more important than complexity. Sticking to a routine builds confidence over time. Regular investment habits reduce emotional decision making. Dollar cost averaging can help reduce timing stress. It spreads purchases across different price levels. This reduces the impact of short-term volatility. Investors feel less pressure when not trying to time the market. Timing the market perfectly is extremely difficult. Even experts cannot predict every move accurately. Accepting this fact reduces frustration and panic. Focus on probability rather than prediction. Good decisions are based on logic, not emotions. Emotional trading often leads to buying high and selling low. Discipline helps reverse this pattern. Having clear exit rules prevents impulsive selling. These rules should be decided before market stress occurs. Reviewing past market cycles builds confidence, and history shows that crypto markets recover after crashes. Understanding recovery patterns reduces fear of temporary drops. Panic often comes from forgetting long-term trends. Long-term charts often look very different from short-term charts. Zooming out gives a more balanced perspective. It is important to separate news noise from real market signals. Not every dip is caused by a fundamental problem. Many dips are driven by short-term sentiment. Sentiment can change quickly without affecting fundamentals. Staying informed helps you make rational decisions. Overexposure to negative news increases anxiety, and limiting news consumption can protect your mindset. Your mental state directly affects investment decisions. Calm investors make more consistent choices. Emotional stability is a long-term advantage in crypto markets. One powerful way to avoid panic selling is to build confidence through research. The more you understand a project, the less likely you are to fear temporary drops. Fundamental analysis helps you focus on real value instead of price noise. Projects with strong use cases tend to survive market downturns. Weak projects often fail regardless of short-term price movements. Knowing this difference helps you stay calm during volatility. Avoid investing in assets you do not understand. Confusion leads to fear when prices fall. Confidence comes from clarity about what you own. Setting realistic expectations prevents emotional disappointment. Crypto is not a guaranteed path to quick profits. Unrealistic expectations often lead to panic during corrections. Accepting both gains and losses as part of the process is important. Emotional balance comes from realistic thinking. Keeping a long-term mindset reduces sensitivity to daily movements. Daily charts can create unnecessary stress for long-term investors. Weekly and monthly perspectives are more meaningful. Avoid comparing your portfolio to others. Comparison often leads to emotional pressure and bad decisions. Every investor has a different strategy and risk level. Focus on your own plan instead of others' results. Confidence increases when you trust your strategy. Doubt is one of the main triggers of panic selling. Strengthening conviction helps reduce doubt. Conviction grows through experience and learning. Keeping a record of successful decisions builds trust in yourself. Reviewing past wins reminds you that markets are unpredictable. Even losses can provide valuable learning learning opportunities. Treating losses as lessons instead of failures reduces emotional damage. Emotional detachment from short-term outcomes is useful. Investors who detach from emotions often perform more consistently. Avoid investing based on rumors or hype cycles. Hype-driven buying often leads to panic-driven selling. Stick to evidence-based decisions whenever possible. Create a checklist before entering any trade or investment. A checklist helps remove emotional bias. If conditions are not met, avoid entering the trade. Discipline at entry reduces panic at exit. Predefined rules protect you from impulsive behavior. Market crashes are emotionally intense, but historically normal. Understanding historical crashes helps reduce fear. Every major asset class experiences corrections. Crypto is no different in this regard. Accepting volatility as normal helps stabilize emotions. Avoid checking portfolio value during extreme downturns. Constant monitoring increases anxiety levels. Taking breaks from the market improves mental clarity. Emotional distance allows better decision making. Trust in your long-term strategy is essential. If your strategy is strong, temporary drops are less threatening. Panic selling usually happens when trust is weak. Strengthening trust reduces emotional reactions. Calm evaluation is always better than impulsive action. Patience is one of the most important investing skills. Staying patient allows time for markets to recover and grow. The final key to avoiding panic selling is building long-term discipline. Discipline means sticking to your plan even when emotions are strong. Without discipline, even the best strategy can fail under pressure. Successful investors focus on process rather than short-term outcomes. A strong process reduces emotional decision-making. Always remember that crypto markets move in cycles. Bull and bear phases are both natural parts of the cycle. Understanding cycles helps you stay mentally prepared. Preparation reduces shock during sudden downturns. Shock is one of the main triggers of panic selling. Expecting volatility makes it easier to handle. Surprise is what often causes emotional reactions. Having a clear exit strategy is just as important as entry strategy. Exit plans should be defined before emotions are involved. Never decide your exit during a market crash. Decisions made under stress are usually poor. Building financial resilience also reduces panic. Only risk capital you are comfortable holding long-term. Financial stress increases emotional sensitivity. Reducing stress improves decision-making quality. Keep learning continuously about markets and investing. Knowledge builds confidence over time. Confidence reduces fear-driven reactions. Avoid reacting to every market rumor or prediction. Most predictions in crypto are inaccurate. Focus on data instead of opinions. Data-driven decisions are more stable during volatility. Maintain a healthy balance between investing and life. Over-obsession with charts leads to emotional exhaustion. Mental fatigue increases the risk of panic selling. Take breaks when markets feel overwhelming. Distance helps reset emotional thinking. Surround yourself with rational and calm perspectives. Avoid communities that promote constant fear or hype. Your environment influences your decisions more than you think. Build habits that support calm decision making. Repetition of good habits strengthens discipline. Remind yourself why you invested in the first place. Your original reasons are your anchor during volatility. Reevaluating fundamentals helps reduce emotional reaction, and strong fundamentals usually survive temporary price drops. Weak assets often fail, regardless of market cycles. Learning to differentiate them improves confidence. Accept that losses are part of investing. Even professional investors experience drawdowns. What matters is long-term performance, not short-term fear. Avoid making decisions based on regret or panic. Regret-driven action often worsens outcomes. Stay consistent with your strategy over time. Consistency builds long-term results. Emotional control is a skill that improves with practice. Each market cycle teaches new lessons. Growth comes from experience and reflection. If you stay disciplined, panic selling becomes rare. Ultimately, patience and preparation are your strongest protections.